Hey guys, defense is what wins championships, all right? And it's applicable in investing too. Guys, welcome to the Independent Investor channel. My name is Ryan. I'm coming to you from the Big Apple, New York City, New York. I thought it prudent to come out with a defensive positioning video really for my viewers and my subscribers out there who are taking in some of my advice. It's a really inopportune time to be getting people throwing all their money at this particular market with it making high after high after high every day, okay? Now there's a lot of people out there that are talking about the stock market is going to collapse, okay, at some point. I tend to derive my opinion based on history or the historical when we look at the market as opposed to what I think is going to happen, really, because what I think is going to happen really is irrelevant, and it's actually really poor information to be pushing out to viewers on YouTube that may get scared out of the market because, you know, the saying, when is the best time to invest? The best time to invest is now, okay? But that doesn't mean we can't acknowledge the current state of the market and be aware of it. And, you know, take a cautious approach, okay? I always say that investing is like a war, okay? And it is. If you are not careful, you will enter into the market too carelessly and you will get burned, okay? It will humble you, all right? Now, I felt with the current timing of the market and with all the information that's being pushed out there right now, I don't hear a lot of people talking about defensive positioning and safeguarding some money. You know, this market has been on a bull run since 2009 when the market was at its bottom. And here we are in 2017, and we're talking about extended bull market runs for the next couple years, guys. Nobody's talking about, you know, the prospect of a pullback, and I'm talking about, you know, 20, 30%. I don't foresee, you know, a 40 or a 50% correction in this market. I really don't, because the underlying fundamentals really just don't support that. And the low interest rate environment they're in actually supports stocks continuing to go up. That doesn't mean that we just enter the market with blind faith, all right? So I wanted to put this video out, and those of you who have been watching me for the last few months since the Independent Investor channel has come out, you guys know that I'm a passive long-term investor, all right? And this is really going to help with the mental side of investing on if you don't have new dollars invested in this market, how cautious should we be in approaching this market? All right, guys, so this is called defensive positioning. I want to talk about the 60-40 rule, all right? Now, there is no perfect allocation within a stock portfolio, okay? I could tell you that a perfect portfolio is 50% stocks, you know, 30% bonds, you know, long and short-term bonds, and the rest is made up of cash, all right? I really want to keep this relative because what's right for me at my particular age may not be right for you guys that are in your 20s and may not be right for you guys that are in your 30s and 40s and so on, all right? The idea here, and in this lesson, when I talk about the 60-40 rule, and that's something that I use, okay? That's not something that, you know, you can read out of a book. That's just something that I kind of use. My current allocation right now in my portfolio is 58% stock and 42% cash, all right? And I've been working really, really hard over the last couple months to actually get my allocation to those levels. Okay, now what is the 60-40 rule used for? It's really used as a tool for you guys to kind of continually balance to make sure that we don't get too overextended, okay? And it especially is workable or usable when you're looking to enter new funds into that account, all right? And you're looking to invest those funds. With the market at an all-time high right now, I would be less apt to encourage you guys to take 100% of your money and just throw it at this market, okay? I just don't think that would be, it wouldn't be a responsible way of approaching this market, okay? Now, it certainly behooves anybody to start investing now, okay? And a lot of people are hitting me up, okay, well, what do I invest in? What stocks do I buy? You know, what ETFs or what index funds do I buy? And they're asking me these questions and they don't have the right account started and they don't have that account funded, okay? So before we get to the actual assets within that account, we need to start the account first, then we need to fund the account. And then we can go in there and we can answer the 60-40 question, all right? Now, when we fund that account, all right, we need to be aware of the annual contribution levels, okay, which is $5,500 in the self-managed Roth IRA account, all right? Now, we're putting those dollars away long-term to be eligible for withdrawal when we hit 59.5 in our life, all right? Now, the reason why we do that is because it's the most important thing that we're aiming for in the future, all right? Now, we can do short-term trades, we can do other things, we can start a brokerage account at a later date, but primarily, we need to meet our long-term goals first by getting those dollars funded in the self-managed Roth IRA account, and then we can fund that account with actual dollars. Then we can talk about abiding by the 60-40 rule. Now, the 40% in cash does not have to be within your self-managed Roth IRA account, okay? It can be outside in a savings account, it can be within a money market account, it can be within a checking account. I don't really care where those dollars are, okay? But for every $40 that we have in cash, we should have $60 invested, okay? For every $4 that we have in cash, we should have $6 invested. And that just gives you kind of an idea to not overextend yourself when you're looking to start contributing to the account. If you had $1,000 right now in this particular market, I think the 60-40 rule is a good way to play. Go ahead and put that $600 in with the intention of putting it to work in this market and withholding $400 in cash. And it's relative as you start talking about bigger numbers, okay? So that's kind of how you use the 60-40 rule, and that just always keeps your mind coming back to defensive positioning. And the question is, if the market went into a severe downturn, would I be okay hitting the stop button and letting my assets ride? Because that's going to be my advice, okay? When this market turns south, I'm going to be doing YouTube videos coaching you guys to stay put in your investments. You do not want to move, okay? And you want to continually ask yourself those questions now when the market is at the all-time high and when nobody else is talking about it. That's the difficult part that you have to understand. When the market's at all-time high, everybody's excited and everybody wants to buy stock. And that's usually the worst time to be buying stock, okay? Now, the risk versus the reward. Remember the self-managed portion to this account. We can allocate and become safe within this account because we are utilizing the self-managed account, which is eliminating all the fees, okay? So we can take a safer posture within this account, guys, because when you guys get these accounts started, I'm connecting you directly to the market. And I would rather see you err on the side of being defensive as opposed to erring on the side of putting all high-risk assets within your retirement account, okay? I'm putting you in the very best account to make sure that the dividends and the dollar cost averaging programs and all the appreciation that you get on these stocks are being paid to you directly and are saving you this money. We don't want to compound the issue by putting high-risk assets within this. There's no reason to do that, right? Because we're already saving so much over the long term by saving on the fees, okay? So you can kind of see how we can take a little safer approach within this investment account and when you get started, okay? That's key, all right? I talked a little bit about this, and finally, this is really important psychologically in how you approach the market and taking kind of a contrarian approach or an opposite approach. For the last couple months, guys, I have been working indefinitely to try to take a defensive positioning. The next couple videos that I come out with are going to be an exact snapshot of my current portfolio, all right? I'm also going to come out with some other videos about the top 5 stocks that should be in every portfolio, and I'm also going to come out with what I consider a high risk portfolio. So you're going to want to stay tuned to that, guys. But this is one of the hardest things to do. I remember in 2009 when everybody was talking, a lot of people lost a lot of money in their retirement accounts during the downturn of 2009. Nobody in their right mind was thinking about putting money to work in 2009, okay? And in retrospect, that would have been the very best thing you could have done, all right? I think we're working through the history of the market back into the 1920s and 30s, going through 40 recessions throughout the history of the market, guys. And in every one of those downturns and in every one of those recessions, we've always bounced back and continued higher after that, all right? So you have to think about opportunistic investing, okay? And right now is not the time to be thinking about opportunistic investing. Right now is not the time to be thinking about 20, 30, and 40% returns over the next couple years. Guys, I've got news for you. The returns that have been had in the market have been had very, very handily over the last 8 or so years. All right? Because I was one of those folks that stepped into the market in 2009 when everybody else was hands off. And I'm trying to teach you guys that right now is probably the time to take the opposite approach to this particular market. Guys, thank you so much for tuning in to the defensive positioning video. This is extremely important for all the new folks that I'm pushing out information to make sure that the assets are being placed into the best account that you can, which is the self-managed Roth IRA account, and that we get those accounts funded. All right? Those two things can be done without putting one single dime into the stock market right now. But certainly it would benefit you guys to have those first two steps completed, because if this market does take a downturn 20 or 30%, you're going to want to be in defensive positioning and switch to offensive allocation and a little bit more aggressive in getting entered into the market when that market takes a downturn, all right? Thank you so much for tuning in to the Independent Investor channel, guys. If you're new to the channel, please hit the subscribe button at the bottom. You'll be notified of any future videos that I put on YouTube. Leave your commentary at the bottom. I'm actually starting a new initiative on the Independent Investor channel. My email is up in the details tab on my channel page. If you guys shoot me an email with your direct phone number, I will call you back on Google Voice. I just helped 2 clients last night. They are subscribers to the channel, and I think both of these individuals will benefit immensely in the future by having that direct dialogue with me. I don't charge a dime. It's free of charge. I'm delivering this information for you guys. Thank you so much for tuning in. Good luck in your investment future.